Welcome back to Protecting and Preserving Wealth. I am John Gay, joined as always by Alex Corey, Jason Hosler, and Bruce Hosler of Hosler Wealth Management. Always a pleasure to be with all three of you.
John, thanks for being with us this morning.
Good to see you again, John.
Good morning, John.
Today we're talking about a 2026 QCD update. Those are Qualified Charitable Distributions. And really what you should know, this is going to be really important for our listeners at that stage of life. Bruce, I know the big thing here is you have to be age 70 and a half to use that QCD, and that is really important.
And it's actual 70 and a half. Like, you can't do it a month early just because it's the same tax year. So we want you to be 70 and a half before you actually make that donation out of your IRA account. A lot of people think falsely that they need to have to retake a required minimum distribution. But think about it. The required minimum distributions now are normally either age 73 or age 75, depending on when someone was born. And it's really pre-1960 or not. You can be 70 and a half and not have a required minimum distribution, but you can still give your charitable gifts out of your IRA with a QCD. This is a great opportunity for some of our clients. And then, Jason, we've had some clients that asked the question, one of our client events, her aunt died and left her an IRA, and she was wondering if she could do a QCD. What's the answer?
Well, if you're the beneficiary of an inherited IRA and you've got that required minimum distribution that you have to make, you can use a QCD in lieu of your RMD withdrawal for the year.
Or up to what amount?
So this year is up to $111,000 per person.
Exactly. In 2026, it stepped up to that, Alex. And here's the thing, Alex. If somebody is thinking that their taxes are tax year 2026, and so here we are early in the year, January, February, March, and they're like, hey, I'm going to be 70 and a half in June. Can't they just do a QCD right now in February because it's the same tax year? Is that okay, Alex?
No. So what you want to do, you need to wait until you actually turn 70 and a half. So by the date, not by the actual year, to make sure it gets recorded exactly as the QCD amount that you want to make it qualify as a QCD and a tax-free distribution.
I want to recap what we've talked about here so far. So you can be old enough to use a QCD before you get to the age of an RMD. I have that right, Bruce?
Correct. That's exactly right.
And if you're the beneficiary of an inherited IRA and you have that RMD requirement, you can use a QCD instead of an RMD for your withdrawal for the year.
As long as you're 70 and a half, that's the catch. So you're the beneficiary of an IRA, of an inherited IRA, and you can use the QCD to fulfill that RMD requirement. But if you're 70 and a half, and you've already taken the RMD, let's say, you can still do a QCD up to the $111,000 if you want to use that for your gifting. And that's where a lot of people miss out on the opportunity on an inherited IRA.
Really glad that we're covering this today. So let's talk about calendar year. Again, as Alex and Bruce have both said, you cannot do this until you are chronologically in age 70 and a half. But assuming you are 70 and a half, let's talk about calendar year 2026.
Okay, so you use the QCD this year if you have a required minimum distribution, and the QCD can replace that, except here's the big benefit. This is the huge benefit that people love. Instead of having taxable income that they don't really need and then maybe giving that to a charity, they just take their RMD and gift that to the charity, and it's not included as taxable income. It's not taxable to the charity either, and it can fulfill your RMD. And so you didn't increase your income, you got to give it to your charity, and the charity didn't pay any taxes. It's a win-win-win.
Says the man who wrote the book, Moving to Tax-Free.
That's right. One thing I want to just clarify on as well is Bruce mentioned taking the money out of the IRA as a QCD. So when you do that, there's an actual, on your form, you must have that checks endorsed to that charity as a distribution from your IRA. You cannot take hold of the money in your name, put it in your bank account, and then turn around and write the check to the charity of your choice. That does not qualify as a QCD. It has to come from the IRA, endorsed directly to the charity. Typically, your broker will send it right to them for you.
So it's a little bit like when you do a rollover. It has to be made out to the proper entity as opposed to you personally.
Correct. It's not paid to you. It's paid to the charity. And so that way they know that it went to the charity, and the custodians now are wanting to make those payments directly to the charity.
And you mentioned earlier that the QCD limitation for 2026 is 111 grand. So a married couple really could give away as much as 222 grand, right?
They can give that much away if they're trying to give their money charitably. The IRA with a QCD is the very best vehicle to give money away. And we're going to talk about some of the new rules on that this year that went into effect, why QCDs are better, in our next podcast.
John, another reason that people might want to roll over a 401k retirement plan into a traditional IRA or a Roth IRA, if they've got that post-tax portion, it allows them to be able to use a QCD. So QCD has to come directly from an IRA and go to that qualified charity. You're not allowed to do that from those employer-sponsored plans like 401ks or 403bs. So it's another tool in your bucket that might be of interest to you and when you're deciding whether to retain funds in a 401k or roll out to an IRA.
I want to come back to a point we made earlier, which is about how the money can't go to you and then the charity. It's really important that it goes directly, and that includes it can't go to your own donor-advised fund. And then also, you can't get anything from the charity. There's no quid pro quo here, right?
Yeah, a lot of times you make a donation at a charitable ball or something like that, and it costs you give money and you get a tend. Well, you and your spouse got that meal worth $75 a plate, and you got some benefit. It's really important that there's a letter that comes from the charity and says you received no financial benefit for this QCD gift that you gave to the charity. And that's why the custodians have kind of tightened this up, because I think they're just giving, they're making a gift and there's no strings attached. And that's very clear. And then the charity, once they receive that check, as a taxpayer, you want to make sure you get that receipt back saying, hey, we've received this money and we've not received, you as the donor have not received any benefits.
Only $75 a plate? What charity dinners are you going to, Bruce?
Well,
I would have expected that number to be much higher.
Well, probably is, but, it's a rubber chicken dinner, so what can I say?
I have way too many of those in my life.
Yes. Now, one of the things that we want to talk about is that QCDs can only be made through a direct transfer of IRA funds. And when I say funds, I'm not saying mutual funds, I'm saying cash funds. And so this can only be made with a cash payment from your IRA to the charity. You cannot make a donation in kind. If you have Apple stock, you can't say, well, just give them some Apple stock out of my IRA. No, you have to sell that in the IRA, and then the charity has to give, or the IRA custodian has to give cash to the charity. That's very important. Also, due to complex nature, sometimes a Roth IRA can have some taxable amounts in it. It's so complex and so hard. We recommend hardcore that you do not try and make one of these QCD donations out of a Roth IRA. So if you have a Roth IRA, we don't want you trying to do QCD donations out of it. You're better off doing that out of other accounts.
And often, John, for our clients that are utilizing QCDs, one of the big reasons is that they're trying to exclude those distributions from taxable income. And
Sure.
so most of our clients will have both traditional IRAs and Roth IRAs. They'll be in the process of moving to tax-free. We're making Roth conversions every year. So there's a few reasons that we want to exclude that income, right? So number one, it could keep your Social Security from being taxable. It can help you stay below the IRMAA penalties. Those are kind of a cliff for a lot of people that they don't pay attention to until they get their Social Security for the next year. And they're like, why is my deduction bigger?
So hold on, Jason. Let's just clarify for our audience, our listeners, so they know IRMAA stands for Income-Related Monthly Adjustment Amount. This is the premium penalty that they take out of your Social Security benefits if you're old enough to receive Social Security and receiving it. Or if you're on Medicare, you have to pay an extra premium over the regular premium because you made too much money.
Now in 2026, we're also going to have this new senior deduction. So for a married filing joint couple, that phase out is from 150 to 250 adjusted gross income. So if you're able to make a QCD and bring down the income that you have to recognize, you might qualify for that new deduction within that range. And it could help you stay below the level that you need to qualify for the QBI deduction for any self-employed business owners.
QBI, Qualified Business Income Deduction for business owners, guys. That's that 20% if you have an S corporation or a partnership or sole proprietorship. So that's a big deduction. You don't want to lose that deduction.
Saving the best for last. Most importantly, for a lot of our clients who are moving to tax-free, we free up more of the tax bracket to use for our Roth conversions if we don't have to recognize that income.
This is the new thing for 2026 is the new 1099 reporting. What's going on there, Alex?
That's right. So the IRS announced that there's a new code Y as in Yankee, for Box 7 of the 1099-R you receive when you make your distributions from your IRA. It's available for 2025 tax returns as well, but this is also something optional. But what's important, though, is this code is specifically for QCDs, your Qualified Charitable Distribution. So I would think everyone would want to make this notation on their 1099-R when they receive it, so that where your tax preparer or yourself knows and remembers that, hey, we made a QCD for the year, it's non-taxable.
And the big deal is here, they made it required, and then in October of 25, they said, well, it's optional for the custodians. So some of the custodians this year may be having that code on the 1099-R for the QCD. Some of them may not. But for 2026, we can now make sure that, you're catching that and you realize, hey, that distribution was not taxable.
The keys here are document, document, document. And
Yes.
because this stuff, as you alluded to, Bruce, gets so complicated, you want to talk to a professional that deals in these types of things. If one of our listeners or viewers wants to talk to you and your team at Hosler Wealth Management, how do they best find you?
Well, certainly they can find us on the website at Hosler, HOSLERWM.com. If they want to call us, Jason, where do they call in Prescott?
Give us a call at 928-778-7666.
And in Scottsdale, Alex, if they want to call you, how do they get you?
Yep, 480-994-7342.
Great stuff, gentlemen. We'll talk to you again in a couple weeks.
Thanks, John.
Thank you, John.
Investment advisory services are offered through Mutual Advisors, LLC, DBA Hosler Wealth Management, an SEC-registered investment advisor. Securities are offered through Mutual Securities, Inc., member FINRA SIPC. Mutual Advisors, LLC, and Mutual Securities, Inc., collectively Mutual Group, are affiliated companies. Forward-looking commentary should not be misconstrued as investment or financial advice. The advisor associated with this podcast is not monitored for comments, and any comments should be given directly to the office at the contact information specified. Any tax advice contained in this communication, including any attachments, is not intended or written to be used and cannot be used for the purpose of 1. Avoiding federal or state tax penalties, 2. Promoting, marketing, or recommending to another party any transaction or matter addressed herein, and 3. Tax preparation and accounting services are offered independently through Hosler Wealth Management Tax Services. Any tax advice provided by tax professionals under Hosler Wealth Management Tax Services is separate and unrelated to any advisory or security services offered through Mutual Group. The accuracy, completeness, and timeliness of the information contained in this podcast cannot be guaranteed. Mutual Group does not provide tax or legal advice. You should consult a legal or tax professional regarding your individual situation. Accordingly, Hosler Wealth Management does not warranty, guarantee, or make any representations or assume any liability with regard to financial results based on the use of the information in this podcast.